Finally, we have defensive stocks. These are companies that are selling goods and services people need regardless of economic conditions. They're called defensive because they tend to hold up better during market downturns. Think of utilities, consumer staples, and healthcare providers. The upside to defensive stocks is that these companies have stable demand. Companies producing essentials like utilities, consumer staples, and healthcare have more predictable revenues even in recessions. They're also low beta, low volatility. Defensive stocks tend to fall less than the broader market during economic downturns. Now, these stocks might not skyrocket during a boom, but they usually drop less during a bust. They also pay consistent dividends. Many defensive companies are known for reliable dividend payouts, which appeals to the income-driven investor. Defensive stocks are valued by more conservative investors who want steady returns and lower volatility. Through multiple economic downturns, Procter & Gamble's lineup of household products, detergents, toiletries remained in demand. Its stock is known for resilience and a stable dividend. Utilities like Duke Energy or Southern Company also have fairly consistent demand. What about the downsides? Well, defensive stocks have limited growth potential. Since demand is relatively constant rather than accelerating, these stocks don't really see big gains during a booming economy. They also underperform in bull markets. When investors chase higher returns in growth or cyclical stocks, defensive stocks typically underperform. And what about regulatory risk? Changes in regulation or government policy can affect revenues and costs significantly, especially for utilities and healthcare. Because of wildfires in California, one utility stock experienced regulatory scrutiny so bad the stock declined and went bankrupt in 2019. This highlights that no sector is completely risk-free. Defensive stocks are ideal for risk-averse investors seeking stable income and protection during economic downturns. So let's do a recap. Growth stocks offer high potential returns, but carry higher risks and higher volatility. Value stocks provide a margin of safety and often steady dividends, but can be slower moving. Cyclical stocks ride the waves of the economy, booming in good times and hurting in bad. Defensive stocks remain stable through most environments, but growth is usually weak. Now you understand the 4 major categories of stocks. Understanding these categories can help you make better investment decisions when it comes to your goals, your risk tolerance, and your economic outlook.